With 20 years of experience in finance and having conducted hundreds of fresher interviews for top companies and college campuses, I have seen exactly where freshers get stuck. In this video, I am sharing the top 25 finance interview questions and answers that are asked most frequently in finance interviews for freshers. Whether you are from BCom, CA, CMA or MBA finance, this video will help you crack your campus placement and first finance job with confidence. Let's get started. Question number 1. What is finance and why it is important for a business? So as you are applying for the finance job, the interviewer would like to understand if you have understood the role of finance in a company. So here is the answer. Finance is the management of funds, raising, allocating and monitoring money to meet business goals. It is important because it ensures the company can operate, example, payroll, buying material, invest in growth and return value to owners. Example, if a manufacturer times raw material purchases and working capital borrowing correctly, it avoids stockouts and reduce interest cost. You can give any type of example, but for your understanding, I have given one example here. Question number 2, difference between accounting and finance. This is where most of the students they get confused because in studies we don't get into accounting, finance and all that because for us either you are doing CA or either you're doing BCom or you're doing CMA. For us, everything is finance. But in corporate, generally there will be two different teams. One is the accounting team and one is the finance team. So let's understand how they both are different. Accounting records and reports past transactions, books, compliance like audit, while finance uses those records to plan future fundings, investments, and capital allocation. Example, accounting prepares the balance sheet, finance uses it to decide whether to lease or buy machinery. So decision making majorly lies with the finance team, whereas accounting team generally takes care of the transactions, recording of vendor payments or recording of customer payments, payment to employees, everything. Question number 3. What are the three financial statements and what does it show? So first one is the income statement or you can say profit and loss account. So it shows profitability over a period. Balance sheet, it shows assets, liabilities, equity at a point in time. Cash flow statement, actual cash inflows, outflows from operations, investing and financing. Example here, high net profit but negative cash flow signals working capital stress visible on the cash flow statement, right? If you're earning good profit, you should have positive cash flow, but if it is negative, that means the management is failing to manage the working capital properly. Question number 4. What is working capital and why it is important? So working capital is current assets minus current liabilities. And what is current assets? Assets which are held by the company and mostly will be converted into cash in 12 months time. For example, your trade receivable, or it could be your cash and bank account, or it could be a deposit account, right? Inventories. The intention of the company is to sell these inventories and convert to cash. Similarly, current liabilities which the company is going to pay within 12 months time. It could be a normal vendor payment. It could be a short-term borrowings. Now, what is working capital? Current assets minus current liabilities. So it measures short-term liquidity to run day-by-day operations. Example, low working capital in a retail firm could force it to take expensive short-term loans during festival stock-ups. Question number 5. Explain accrual versus cash accounting in one line. Okay, so what's the difference? So accrual records income expenses when earned, incurred, the matching concept. Cash records when cash actually changes hand. Example, revenue recognized on invoicing under accrual, but cash may arrive 30 days later, right? So in accrual, it depends if you are doing expenses, then based on conservative case, you can take a provision for it, you can accrue for it. Similarly, in case of revenue also, if you are achieving a milestone, you can recognize the revenue even though invoice is not raised. So accrual and matching concept is different and cash flow is different. Cash generally, whenever you receive a cash or you make a cash payment, in that case, it will be recorded. Question number 6. How do you calculate EBITDA and why it is used? So EBITDA is operating profit plus depreciation plus amortization or revenue minus operating expenses excluding depreciation and amortization. It is used to compare operating performance by stripping non-cash and financing effects. Example, two firms with different tax rates are compared using EBITDA to access core operating profitability. And this word is very commonly used in most of the companies because they majorly focus on EBITDA instead of EBIT, because they want to see that if you remove the non-cash item and taxes, whether the company is making profit. Question number 7. What is cash conversion cycle? Name its components. So cash conversion cycle, the formula is days inventory outstanding plus days sales outstanding minus days payable outstanding. It measures days to convert inventory into cash. Example, a firm reducing days sales outstanding from 60 to 30 days improves liquidity without new financing. As you are able to sell faster and you are able to collect the money from the customer faster, you will not have any liquidity challenges because you are getting money much in advance compared to what you expected. Now, question number 8. How does depreciation affect the three statements? So in income statement, increases depreciation expenses, lowers profit. In balance sheet, accumulated depreciation reduces net book value of assets. Cash flow, depreciation is a non-cash expense added back in operating cash flow. Example, buying an asset increases PPE, so PPE is plant property and equipment in balance sheet, and reduces cash, that is cash flow from investing activities, because when you're buying asset, it is investing activities. Latter, depreciation lowers reported profit but not cash, because when cash flow, the depreciation will be removed. It will be added back to the operating income. Question number 9. What is goodwill and when it is recorded? So goodwill arises when acquiring a company at a price greater than the fair value of its identifiable net assets. It's an intangible asset on the acquirer's balance sheet. Example, buyer pays premium for strong brand and customer base. Difference becomes goodwill. That means in case of merger or acquiring a new company, if the buyer is paying more than the fair value of the assets taken over, then the excess amount paid to the seller will be treated as goodwill. And in the reverse case, where you're paying less for the assets you are buying, then it will be a capital reserve. So when you pay excess, it's goodwill. When you pay less, it's a capital reserve. Question number 10. Explain current ratio and quick ratio. So current ratio formula is current assets divided by current liabilities. And the thumb rule is that current assets should be higher than the current liabilities so that you don't have any liquidity challenges. But few companies, they use quick ratio. That means they don't want inventory to be part of current assets because it takes time to get converted to cash. So in case of quick ratio, the formula is current assets minus inventory divided by current liabilities. And quick ratio excludes inventory for more conservative liquidity view. Question number 11. What is break-even point and how to calculate it? So break-even point or break-even unit equal to fixed cost divided by selling price per unit minus variable cost per unit. Mostly to see that at what point of time you will be recovering your fixed cost. So it's the sales level where profit equal to 0. Example, if fixed cost is rupees 1 lakh, price per unit is 100, variable cost is 60, then break even units equal to 1 lakh divided by 40. How 40? 100 minus 60 equal to 2500 units. So when the company sells 2500 units, it will have no profit and no loss. Question number 12. What is a budget and variance analysis? So a budget is a financial plan for future periods. Variance analysis compares actuals to budget to explain differences and take corrective actions. Example, marketing spend variance shows actual 2 lakh versus budgeted 1.5 lakh. So in this case, you need to investigate. It could be your campaign scope or the vendor rates. You need to find out why there is a difference between the budget and actuals. Question number 13. How would you forecast revenue for a simple product? Use a bottom-up approach. Estimate units sold, that is your market penetration or historical trend. Multiply with price. Adjust for seasonality and promotions. Example, if monthly footfall grows 5% and conversion is 2%, forecast unit sales accordingly and multiply by average selling price. So wherever companies They know that in particular season, like for example during Indian holidays like Diwali and Dasara, the sales goes up, right? In that case they can forecast a higher one, and wherever it will be off season they can forecast for a lower one. So you have to take all your historical data and project your future forecast. Question number 14: what is EBITDA versus net profit? Why might they differ? So EBITDA excludes depreciation, amortization, interest and taxes. Net profit is after all these. They differ due to non-cash charges, that is your depreciation and amortization, and financing tax effects. Example, capital intensive farms shows high EBITDA but low net profit becomes a large depreciation. Question number 15. What are deferred tax assets and liabilities in simple term? So here you need to explain in short what is the meaning of deferred tax asset and liabilities. They arise from timing differences between accounting profit and taxable profit. Deferred tax asset equal to future tax benefit. Deferred tax liability equal to future tax payable. Example, if tax depreciation is faster than books depreciation, taxable income is lower now and it creates a deferred tax liability. That means in future, you will be paying more tax because depreciation under income tax will be lower in future. Question number 16. Explain the concept of time value of money and a short example. So money today is worth more than the same amount in future due to earning potential. Discount future cash flows to present value. Example, 10,000 today invested at 8% becomes 10,800 in 1 year. Question number 17. How to calculate net present value in one sentence? So net present value equal to sum of discounted future cash flows minus initial investment. Positive NPV means projects add value. Example, project cost is 1 lakh and the return is 30,000 per year for 4 years at discount of 10%. Compute PVs and compare to 1 lakh, and if it is higher, it is a good project, and if it is lower, then company will not invest because you will end up with loss. Question number 18. What is working capital financing and common sources? So short-term funding to bridge timing gaps between inflows and outflows. Sources includes your bank overdraft, cash credit, short-term loans, supplier credit, and factoring. Example, seasonal manufacturers use cash credit to fund raw material purchases before receiving sales proceed. Question number 19. Explain basic ratios used to evaluate profitability. So what are the different ratios used to understand how the company is earning and how to interpret the profitability of the company? So the first one is gross margin, that is revenue minus COGS. COGS means cost of goods sold divided by revenue. Operating margin equal to operating profit divided by revenue. Net margin equal to net profit divided by revenue. Then ROE, very commonly used in stock market. ROE formula is net profit divided by equity. Equity means your net worth. Example, improving gross margin from 30% to 35% by lowering material cost directly increases profitability. Question number 20. What is capital expenditure, CapEx, versus revenue expenditure, OpEx? So CapEx creates or improves long-term assets, capitalized and depreciated. For example, if you're investing in building, plant and machinery assets, these are all CapEx. OpEx are recurring expenses for operating purpose or for operations. Example, buying a delivery vehicle is a CapEx, but the fuel cost for running that delivery vehicle is OpEx. Question number 21. How would you prioritize tasks during month-end close? Focus on high impact reconciliations like bank, inventory, receivables. Then cut-off entries. Cut-off entries means for your purchase and revenue, you have to do a cut-off procedure to see that what record keeping you need to do for purchase and sales at the month end. And key variance check. If there is any unusual movement, you need to check and find out why there is an unusual movement in particular ledger. Communicate deadlines to stakeholders. Example, reconcile intercompany balances early to avoid delays in group consolidation. Question number 22. How do you ensure accuracy in reporting? This is very important if you are applying for record to report team or GL team. You will find this question very often. So reconcile balances, use checklist, maintain version control, validate with supporting schedules, and perform reasonable checks, trends or ratio analysis. Example, cross-check cash balance with bank statement and cash book before signing off. So bank reconciliation is very important. You can't miss entries and close your books because your cash flow will impact and your numbers will impact. Question number 23. Give one example where you improved a process or saved cost. So you can say during intensive, automated a petty expense tracker in Excel, reducing manual consolidation time from 4 hours to 30 minutes per month, improving timeless and accuracy, explain steps, designed template, validation check, and trained users. Obviously, you will not have, as a fresher, you will not have the experience to talk about more about cost saving, but as if you have done some automation, have reduced some man hours, that will be a good example in the interview. Question number 24. What is ROU asset and how it is reported in financial statement? So this is mostly connected to IFRS 16 or Ind AS 116. A right of use asset is an intangible asset that represents a lease's right to use a leased asset during the lease term. ROU assets are a key component of lease accounting and are recognized on the balance sheet alongside a corresponding lease liability. So in case of lease, you need not show as expenses. You have to create an asset and a liability for it. Coming to our last question, question number 25. One strength and one weakness related to finance work. And this is very commonly asked by interviewers to see that what is your strength and what is your weakness. So always start with your strength. You can talk like attention to detail, eye catch reconciliation mismatches early and prevent restatements. Weakness, you can be open here because you are fresher, so you can talk about your weakness. It could be like public speaking. In meetings, I used to be reserved. So I joined a webinar group and now present monthly reports confidently. Give a real brief example to show improvement. So whenever you talk about weakness, you can add how you are improving that weakness. Don't only talk about the weakness and then be silent. So that's it from my side. Hope you have enjoyed this video. If you have liked this video, please like this video, share with your colleagues and friends so that they also understand or they also are well prepared for the interviews. And if you have not yet subscribed to my channel, I request you to subscribe to my channel. If you have any other questions, please write in the comment box. I'll be happy to reply to your questions. Thank you.